Mr. Troy Niehaus would like to thank you so much for your work today and helping to bring together these speakers. I'm going to turn it over to you, sir, to do a little introduction, and then we'll turn it over to the speakers today.
Thanks, Brianna. I appreciate it. Hi, everyone. Most of you know me and are familiar with Bernstein, but for those who don't, let me just say a few words. Bernstein's a global investment research and management firm with offices in 25 countries. It's our sole focus. We have 20 offices here in the US. I'm an angel investor and have been a Kretzu member for about 10 years now. As an advisor with Bernstein in our Seattle office, I focus my practice on entrepreneurs. I'm a former tech startup owner and have been a president of a hardware manufacturer. And so I understand the psyche of a business owner and the contributions that they make to our economy and communities. With all the craziness in the markets, it's definitely a great time to get a health check on your own investment portfolios. So if you want to confirm that your portfolio is actually built to withstand this volatility, we can help, and there's no charge. So just reach out to me, let me know if you'd like our team to run a deep analysis of your own investment portfolios. For this presentation, I'm really excited to bring on Hrug Ved. Hrug is a senior investment strategist in Bernstein's San Francisco office. He's also a member of our private client investment policy group, and that's the group that provides asset allocation, investment, and risk management advice for our ultra high net worth clients, plus endowments and foundations. Before joining the firm last year, Hrug served as a portfolio manager at PAMCO. That's a multi-strategy hedge fund. And prior to that, he was an acquisitions associate at JER Partners, which is a real estate private equity firm. And before that, he was an investment banking analyst at Deutsche Bank. Hrug holds an MBA from Northwestern at the University of Kellogg School of Management and a BS in Finance and Accounting from Georgetown University. And he's also a CFA charter holder and holds a certificate in quantitative finance. Todd Bix, who will join the call for Q&A, the Q&A portion after Hrug's talk. He's a senior investment strategist also. He's in our San Diego office. Todd is the firm. He's responsible for strategic oversight and management of different portfolios for our ultra high net worth clients in our region. He's also a member of our private client investment policy group. Prior to joining the firm back in 2012, he was an analyst at Alliance Global Investors, where he focused on global financial stocks, including banks, asset managers, exchanges, real estate investment trusts, and insurance companies. And before that, he was an associate here at Bernstein. And while he was in that role, he covered U.S. brokers, broker-dealers, money center banks, and asset managers. Todd began his career in financial services as an equity trader at Goldman Sachs way back in 2001. Todd holds a BS in engineering from the Naval Academy and an MBA from the Tuck School of Business at Dartmouth. So without further ado, Hrug, thank you so much for taking the time, and you've got the con.
Thank you, Troy, for the intro. It's nice to speak to everyone. I wish I was speaking to everyone in person up in rainy Seattle rather than doing it over video conference. But we will have to make do with the times. So let me go ahead and share my screen, and hopefully the AV is working correctly. All right, it looks like it is. Can someone just confirm that they can see the presentation that I put up?
Yes, we can.
Okay, very good. Okay, perfect. So, typically, we start our conversations with clients and our endowment and foundation saying that, we're not authorized and we're not capable of providing tax and legal advice. And we're in the strange predicament these days where we're also saying that we're not able to provide health advice and we're not epidemiologists. But with that said, I think it's important to level set and set the stage for what the coronavirus is. Everyone has seen these charts, everyone has seen versions of this data. But in order to go on for the rest of the conversation and to put everything into perspective, really, and that's putting things into perspective is the theme of what I'm going to be talking about over the next 20, 30 minutes. So it's important to set perspective on what the coronavirus is relative to past epidemics, to the COVID-19 pandemic that we're in the middle of today. So in the far right of the screen, you can see that as of last week, so this all is data as of last Thursday or Friday, is when we last updated this presentation. The coronavirus had confirmed cases of 191,000 cases with about 7,800 fatalities. So a mortality rate of 4.1%. So comparing this to SARS, the swine flu, and bird flu, one thing that's very different about this virus compared to other viruses is that it has, what we say is a medium to high amount of communicability, meaning that it's, easier to spread compared to other viruses here, such as SARS, but it also has a medium amount of fatality. So unlike the swine flu, which was very communicable, but did not have a very high fatality rate, this COVID-19 virus this time around has, a medium amount of both communicability and fatality rate, which is why we're unable as investors to draw direct comparisons from past epidemics that we've seen in recent history to what we're seeing in the coronavirus. The last pandemic of this scale was the 1918 Spanish influenza, which was before the time of modern markets. So it's not a good comparison of what may happen to both economic growth and financial markets. So with that said, going on to, the virus data and what we're watching, everyone is looking at, the Johns Hopkins website and finding their kind of favorite source to get, the latest data. One thing that, we like doing here is just kind of understanding the pace at which the virus is growing in different geographies relative to when that country, that geography, passed 100 cases. So what this is doing is that it's starting each line on the left-hand side, the bottom left-hand side, on the date at which the virus passed 100 confirmed cases in that country, and then it shows the growth rate of the virus on an apples-to-apples basis on a similar time frame. And what we can see here, and again, this is data as of last week, last Friday, is we are hoping that we see a flatter curve, similar to what China was successfully able to do, if you believe the data that they have put out, around day 23 to 25 of when cases passed 100 outside of Hubei province. China was successfully able to contain that virus. The Western world has not been able to successfully contain the virus as quickly as China has. But, one of the things that we're watching closely is to see a tapering off or a flattening of the curve as different geographies, get farther into their experience with the virus. And hopefully, we start seeing other Western economies follow the course that China outside of Hubei and South Korea were successfully able to do with the public health measures that they enacted. We all know that, as residents of the Pacific Northwest and me in the Bay Area, the public health measures really started in earnest, the beginning of last week. So unfortunately, given the the type of virus this is, and having symptoms show up on up to 14 days later from when the virus is contracted, we won't really see a flattening of the curve, we expect, until sometime into next week, to see if the public health measures that we're taking are being effective in slowing the growth rates. But as I look at the daily data that came out yesterday, one thing that I'm hopeful about is that both Italy and the United States have seen a dramatic amount of reduction in new virus cases, with the daily increases going from 30 to 40% down to the single digits or in the teens. So the data is promising, but again, it's early, and we all know that virus test availability is a big concern, and the data itself may not be as reliable, especially in the United States, given the lack of testing that's available, given the supply chain disruption there. Now, to put this into perspective, and kind of transitioning the virus into what we're seeing in the financial markets, I think it's important to understand how good we've had it, frankly, for the last 10 years, coming out of the global financial crisis, and also in more recent periods. Typically we see that the number of weeks that it takes for the market to go on without having a 5% correction is 9 weeks. Going into this, we had a 28-week period without a 5% correction. Usually it takes 31 weeks for the market to endure a 10% correction. This time around, we had a 62-week period without a 10% correction. And then also, the number of weeks between a 20% correction is usually 106, so maybe 2 years. Every 2 years, you typically get a 20% correction in the market. And this time around, we've had a 10-year period, or 573 weeks, without having a 20% correction. So perhaps, one of the reasons why we're all feeling uneasy about the value of our investment portfolios and what's going on with the financial markets is because it is a bit in the rearview mirror. But I think it's important to put things in a perspective, again, going back to the theme of today, to understand that corrections in the market are healthy, that the market does react to economic surprises both on the upside and the downside. And this pandemic, while it's nothing that anyone could have foreseen with any type of precision, the market does have events that cause the market to correct 10 to 20% on a fairly regular basis. I'm just kind of going forward to a larger picture, going back to the 1980s. We had a number of events that caused peak to trough drawdowns of greater than 20%. We had the savings and loan crisis, the Black Monday of 1987, the dot-com bubble of the late 90s, early 2000s, obviously the global financial crisis, the European debt crisis, in 2018, the trade war with China, and now we're in this coronavirus outbreak. But if you look at the chart and kind of unfocus your eyes on the near term and look at just the path of this chart in the long run, you see that the line goes from the bottom left to the upper right. And that's what we continue to expect going forward. While we don't know what the impact of the virus will be and how severe it will be and how it will impact the economy and the value of our stocks and bonds, we do know that eventually fundamentals will rule the day. That once investor sentiment has been confirmed, that investors will value companies based on their cash flows, and in a low return environment, in a low investment rate environment, bonds should be attractive relative to a world where risk-free interest rates have been brought down to zero by central banks. So just to kind of go through where we are, we've talked in generality so far, but checking the data as of this morning, global equities are down anywhere from 23% to 35% for the year of 2020. And the peak of the market was in mid-February, where the markets were up roughly 5%. So add 5% to see to the numbers that I talked about before. So the peak to trough drawdown that we're in, or the amount of correction, is about 28% to 40%, depending on how you're invested, whether it's U.S. markets, international markets, large caps, small caps. And then bonds on the what should be the safer side of our portfolios are also they're doing their job of protecting capital relative to equities, relative to stocks, but a government bond portfolio is basically flat for the year, and I'll talk about some interesting things that we're seeing there. Municipal bonds, which is a very important part of our clients' high net worth taxable accounts, because of the favorable tax treatment of municipals, have seen quite a difficult market, and are down anywhere from 5 to 10%, depending on how you're positioned. And then corporate bonds, investment grade bonds, safe companies and safe bonds to companies are down anywhere from 5 to 10%, whereas high yield bonds, otherwise known as junk bonds, are down anywhere from 15 to 20%. So that's just a kind of a lay of the land of where we're at today. given the impact of the coronavirus and also an external shock that we got from the oil sector that I'm happy to answer in the Q&A if anyone is interested. But now we talk about transitioning to what the government response has been. So government response is broken into two areas. One is monetary policy, which is the actions that central banks can take to ensure liquidity in the financial markets and a functioning financial system. And the second thing that governments can do is fiscal response or fiscal stimulus. And this is what, increase government spending and increase, concessions to people and businesses that can be done by the legislative and executive branches of government. And I'm happy to go into what we've seen take place there. And I'm happy to report that the government is acting with quite a lot of speed and quite a lot of impact here. On the fiscal side on the monetary side of things, we've seen central banks take interest rates down from 1.5% in the Fed funds rate at the beginning of the year down all the way to 0. So they used all of the interest rate cuts that they had in their quiver, and they spent all those arrows and did the wise thing, which is the consensus of economists across the world, that they acted big and they acted fast. So interest rates are now at 0. We're also seeing a commitment to conduct asset purchases, otherwise known as quantitative easing, to make sure that there is buyers for safe assets, in addition to investors like you and I. So previously they had committed to doing $700 billion of quantitative easing, which is actually a similar amount, and in fact more than the quantitative easing that was announced in 2009 coming out of the global financial crisis. But that was actually expanded over the weekend. So it's not 700 billion anymore. The latest language that we're getting from Jay Powell at the Fed is that they will do quantitative easing in the amount necessary to ensure functioning capital markets. So call it QE infinity, call it whatever it takes, call it a shock and awe. This is a large commitment to make sure that the Federal Reserve is not going to play around here, that they are serious about doing whatever it takes to make sure that the markets have the liquidity that they need, so that asset prices can be as closely valued based on fundamentals rather than panic and fear that the financial markets are not working. And I just want to turn quickly to this slide, which charts the yield or the return that you can get by investing in 30-year Treasury bonds of the U.S. government. So, Treasury bonds, historically, the safest asset class, it's the classic flight to safety asset. So when stocks go down, Treasuries tend to go up because it's a safe haven asset that people tend to just want to hoard in. But we saw something very interesting happening last week, which is that after the early stages of the coronavirus, where bond yields went down as people bought up these bonds and brought down their interest rates, we saw interest rates track back up, and that wasn't because everyone thought that things were ho-hum. This was because that people didn't even want to take treasury risk. People didn't even want to take long-term treasury bond risk. What they wanted to do was move to cash, and this is a scary thing. Because if we can't rely on the safety of the 10 and 30-year Treasury bond, we're not going to be able to, it's going to exacerbate the fear that investors have. I'm happy to say that after this week and after the action that we saw from the government over the weekend and the Federal Reserve over the weekend, we've seen quite a retracement in the upward move in the Treasury bond, and it has continued to move back down. So 30-year Treasury yields down back at 1.2%, 10-year Treasury yields down back at 0.8%. So acting a little bit more normal, seeing that the commitment from the Federal Reserve continues to work its way through the system, and the actual dollars are hitting the markets, and the Federal Reserve is buying as we speak. So now moving on to the fiscal stimulus. This is, again, talking about the amount of government spending that the government can do to ensure that the economy doesn't take too much of a hit as a result of the public health measures that we have right now. Last week, we started the week thinking that the fiscal stimulus package would be $800 billion. Then we thought it would be $1 trillion, and then there was talk of $1.2 trillion. This morning, it looks like today the Senate is going to pass, and the president will sign a $2.0 trillion stimulus package. Let's put that into perspective. Again, going back to the theme of today. In 2008, 2009, after the global financial crisis, where the residential home market was in shambles, consumer personal balance sheets were in horrible shape. We had extended too much credit to borrowers that couldn't be able to afford the paying off those debts. The fiscal stimulus at that time was three measures. One was cash for clunkers, if anyone remembers that. The next was a tax rebate check in George W. Bush's last year of office. And then after the Obama administration took hold in 2009, there was America Recovery Act. That was an aggregate of $800 billion. So this package this time around of $2.0 trillion is more than 2x the type of fiscal stimulus package than we're seeing than what we saw in the global financial crisis. So the problem with this one this time around is that no amount of interest rate cuts, no amount of quantitative easing, and no amount of fiscal stimulus can cure a virus. We know that. But what we do know is that after the virus abates, there's going to be a lot of wind in our sails to propel us back as close to the trend line that we were on as possible. We probably won't get back to that trend line because there has been significant layoffs that have occurred in the economy, and maybe those firms weren't profitable and to begin with, and will choose to shut down. And we know that parts of our industry, parts of our economy, like the energy industry, continue to be very challenged. And given what's transpired between Saudi Arabia and Russia in the last 2 weeks, we think that the onshore hydraulic fracturing, unconventional wells, that is long-term challenge, and that industry may not come back. But hopefully, with the effect of this quantitative easing, fiscal and monetary stimulus, we'll have as good of a chance as possible to get back to the trend line that we were on before. So I just want to end today talking about what we're doing here at Bernstein. The best advice that we're asking our clients to do. First is stay focused on the long run, especially for many of us that have a long-term perspective. Perhaps we have generated the amount of wealth in our lifetimes that exceed the amount of spending that we foresee to need for the remainder of our life, and we're not really investing for ourselves. We're investing for future generations and for our charities that we care so deeply about. For that, it's important to stay long-term focused and to know that the cost of long-term growth is short-term volatility, and understanding that the plans that you have worked out with your advisors or yourselves to stay in a well-balanced portfolio is designed to kick in just at a time like this. So not panic, not sell down your stocks, because we know in order to be for that to pay off, you have to be really right. You have to be able to call it right that you're going to sell it at the when there's still more room to go down, which we don't know, and we have to get back in at a time when the all clear signal is given. But the problem is there is no all clear signal that the market gives you, so you don't know when to get back in. What we're seeing is there's incredible value. Municipal bonds I mentioned earlier in the conversation that are down 5 to 10%. Historically, municipal bonds are an area that have been extremely safe, even in the global financial crisis. Investment grade or safe municipal bonds only defaulted with a rate of 0.2%. So they basically didn't default. Currently, because of panicked retail investors that may not have as good advisors as Troy on this call, have been dumping their municipal bonds, and currently the yields on those portfolios are 4%. So 4% relative to an after-tax yield on the U.S. Treasury of 0.4%, being 10 times as good, sounds pretty good to me. And other things that we're doing in our equity portfolios and our stock portfolios, we're really using this opportunity to buy long-term durable businesses that frankly we've coveted for quite some time. You can guess in the Pacific Northwest, there's a couple companies up there that were really, really good companies, but just traded very, very expensive. And now that, we've had a market correction, and we think that, these are companies that we've coveted and now traded much more reasonable type valuations. It's time to buy those companies, not for the next 3-month rebound, but for the next 5 years. So taking advantage of opportunities to rotate into higher quality names that are now, more affordable, and have a kind of a, are giving us the green light, whereas previously, great companies, but just bad, not good enough stocks for us. So let me end it there. I'm happy to answer any questions that the audience has. But again, thank you for letting me speak today, and I look forward to engaging with this forum in a deeper way in future periods, where hopefully, we're not talking about viruses and we're talking about more interesting things like that.